Yeah, at the money, that's pretty cool mathematically. At the money, the delta is always 50, but that's only when the stock price exactly equals the at the money strike price. So if the strike is 100 and the stock is at $99.92 and it's going up, once it hits $100, the delta is going to be 0.50.
0.50.
It's going to be
Okay.
50 cents. 50 cents.
Mm,
Cents, by the way.
okay.
So,
Mm,
and what it represents is for every dollar that the stock goes up, you're going to get that much in cents. So if it's a 50 delta, that's 50 cents. So if the stock goes up to $101, you're going to make 50 cents per share or $50.
oh,
Yeah.
okay.
Yes.
Mm.
Yeah. All
So
that.
what at the money when the delta basically the delta represents what you will be getting if the stock goes up
Yeah, and or down. So if you bought it to
or
50,
down. Okay.
if you bought it to 50-cent delta, um, as the stock price goes down, you'll be losing 50 cents per dollar that the stock price goes down. If
Mm,
the stock price goes up, you'll be making 50 cents per dollar that the stock goes up times 100 shares because you have an option contract of 100 shares. So
yeah, yeah,
yeah,
yeah.
50
Okay.
bucks. Yeah. That's why Tesla, I mean, Tesla can move. Amazon is a great example. That's why Amazon's so expensive because on the one hand, yeah, it costs $60,000 for me to buy that one contract, and I have 100 shares, but I have 100 shares of Amazon, and it's at 31.50. So that means I have $315,000 of Amazon
Mm,
that I only paid $60,000 for. And if it goes up 100 points to 32.50, I'm making 100 shares of profit for every point or $10,000.
mm.
But if the delta is 50 cents, then I'm only making $5,000. So, et cetera, et cetera.
Yeah, yeah. Oh, I see. Now
Yes.
let's talk about puts. Can
Yeah,
you
okay, sure.
the best because it looks like sometimes the market now we're in a market where it's mostly red. Right? So
Yeah.
why don't you take advantage of it instead of waiting for the call time? So if
Yeah.
you can, what will be the best strategy? I guess
Yeah.
if we're doing a day trade or a swing one for puts, which one would it be the same thing at the money or in the money the same way that we do for calls? Can you give like quick summary on that for us?
Well, yesterday is not a great example, but like yesterday when IMMU was going down, I recognized that. I was like, hey, like I told you, was like
Mm-hmm.
a good way to think. What's not happening here? So like with Emu, it had such a great reaction yesterday, and that morning in pre-market that it looked like it was going to just do so great when the opening bell happened, and it wasn't. So my first thing that went off in my head was, hey, what is this not doing? It's not going up. So for whatever reason, it's not going up, and it looks like it's going down. So I'm going to buy puts. So I looked at it and I picked up a bunch, I think of 50 or 100 puts, and they were only 5 cents a share. So $5 a contract. So
Mm-hmm.
I bought a ton of those puts, and at their max value, they eventually ended up being, I think, $60 per contract. So I made like
So
1,200%.
what was you bought $5 at a contract? So was it like other money or?
It was way out of the well, as far as puts are concerned, it was way out of the money. But usually you consider out of the money like way up higher than the price.
Mm-hmm.
But with
Mm-hmm.
puts, it's way down lower. Everything's flipped upside down. So in the money with puts is a
Mm-hmm.
higher price. It's where the stock isn't.
Okay.
So weird, but
So your strike would be exactly where either at where the stock is or over where the stock is. It's like when you're selling short, you're looking for the highest price to sell, right?
Yeah,
So
yeah.
puts will be exactly if you if you well either where the price is or above where the price is will be your strike. Is that correct?
No, not necessarily. I mean, just like you can buy an in the money, at the money, or out of the money call,
Mm-hmm.
you can also buy an in the money, at the money, or out of the money put. So it could be above or below, but that's going to reverse whether it's an in the money or an out of the money. So with a call,
Mm-hmm.
uh, at the money means where the current price of the stock is roughly, is where the
Yeah.
strike that you're choosing is. And then in the money is lower. So like if it was $100 stock, in the money strike would be 90, the 90 strike. I think you get that now, right?
Yes, I do. Yeah.
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 But if you were buying puts, the in the money put would be at 110 strike.
Oh, I see.
Pretty weird,
Mm-hmm.
right? But that's
Yeah.
in the money put. It's saying, hey, I have short shares from 110 down, and the stock price right now is 100. So I'm in the money $10 per share.
Okay.
Yeah,
Okay.
and now out of the money would be even lower. The 90 strike in puts would be out of the money. It's not there yet. You haven't got the stock to go there and lower so you can make money yet. So it's out of
Mm,
the money.
okay. Yeah.
It's
Okay.
it's not easy to grasp at first, and but luckily you've made a couple options trades now, right?
Yes, I have. Yeah.
Okay, so you're starting to get the hang of it a little bit. It's just so much
Yeah.
easier to do one. It's like, I know otherwise you can talk about it forever and it's hard to learn. But now that you've done some, if you try to do a put, I don't think you're gonna take too long. 3 minutes for you to figure it out. Once you've done it, you're gonna, okay, like that. But it's upside down. So that's how it works. And probably in any way, you're probably going to be getting the at the money puts anyway, because you might be doing a day trade of some kind or some kind of really short term swing trade because,
Yeah.
who knows how long these things are going to stay red. Bear markets only last, I think, 10% as long in over the course of history than bull markets. So, mostly stocks go up. I mean, it is true. But, they're businesses, they make money, they have earnings, revenue, profits, they grow, they gain in value, they continue to go up. 10% of the time stocks go down. So when you're in a red time, it's more difficult, but it depends on the time, but it can be more difficult to consistently make a fortune, you know, on the way down because everybody's trying to go long, you know. So market tends to go up. Even when it's going down, it just tends to go up. It has a 9 out of 10 favor to want to go up. But it just happens to flip-flop back and forth all the time because if you bought a used purse that you were going to sell later, and it was a lot, like $2,000, you're not going to buy another one until you sell that one. So you're in now. So now you have to wait for the prices to go up. Now you'll sell. And then now that you've sold, you won't buy again until prices come down. And it's the same way with the market. So the market has to pump up and down to continually attract people that would later sell to buy so that they can be the supply later to sell. And it's just this constant cycle.
Good explanation. Thank you.
Yeah. But it wants to go always up. I mean, as time goes on, everything goes up. Even though it goes up and down, it's going up. Except for shitty penny stocks. But that's why they're on the OTC. So let's see. We talked a little bit about puts, maybe not fully, but it was a good first primer to talk a little bit about puts there. And we could talk about that a little more to figure it out in a little bit here. And Sachin wanted to talk about sizing in and out of position, so I talked about that. The user in there named Enlight, she wanted to talk about rolling. I'm just going to go over what that is really quick because maybe you'll start to hear that. Sachin probably has if he's been studying videos. So rolling a stock is simply selling rolling an option, is simply selling the one that you have and buying another one of similar something, whether it's a different strike or a different expiration or something at the same moment. It's just a way of saying, hey, I'm not done with this stock yet. I want to stay in, but I want to change up. It's like a way you can change your option to another level. Either you can buy more time or you can buy up some strikes. So now one of the cool things you can do with rolling options is you can take your profit out without selling, essentially. So you probably won't get this right now, but I'm still going to go over it just so that by the time I tell it the 5th time, you'll get it. But let's say you bought a 90 strike in the money option on a $100 stock, and that stock went up to $110. Now, instead of just selling, because maybe you think it'll continue, you can take all of your profit off the table now without losing your position. And you do that by rolling. You can't do that with stock. With options, you can. It's very cool. So what you would do is you'd instantaneously sell the option that you had that was 90 strike, and you would simultaneously buy like the next level up, which would be the 100 strike. So the stock's now 110, and if you buy the 100 strike, it's the same as when the stock was at 100 and you bought the 90 strike. You're just leveling up. You're just, boom, you're still getting $10 in the money, but you're buying the one that's now at 100 when the stock is at 110. And it ends up costing the same as when you paid for the 90 and the stock was 100. And so therefore, if you're selling this one, which went up in value, and then with the proceeds, you're buying this one, which was as cheap as when you bought the other one, then you're trading the option for the other one, and you're taking out your profit. And that's a way you can roll. That's a way you can take profits out of your options without losing your position, is rolling up to the next strike or up to the similar strike. If you were 10 in the money and now it's 10 in your favor, and you take that 10 out. Now another thing you can do is you can roll not up to get your profit out, but you can roll out. So let's say you have made more money on the 90 strike. It's $110, $110, the option, the strike, the stock is $110. You bought it when it was 100, you bought the 90 strike. Now it's 110, so follow me on this. And so you have $10 a share of profit essentially sitting there. Well, you could, if you wanted to buy more duration because maybe the stock just got some great news and you just want to keep riding, but you want to buy more duration because expiration on your option's coming up. Well, you can buy the 90 strike of the next duration now with the profit that you have. And so you can roll into the next duration for free. And you might even be able to take a little bit of money off the table, depending on how the pricings have changed. So you can buy more duration with your now profitable option by doing an expiration roll. It's a simultaneous selling and buying of your option and the new option you want to get at the same time. It's called a roll. And the better brokerages will give you the option to roll. Just about every brokerage I'm with has roll. I don't know if like Robinhood and Webull have roll. Maybe they do. But yeah, that's really option and awesome. And you can combine them. So you can also take some profit out by going up a strike and you can buy a little more duration if you want to. Or you can even do the opposite. You can say, hey, look, this thing moved in my direction way before I expected it to. I'm going to pull back the duration now to where it expires like tomorrow, and I don't need all that duration anymore. So you can roll it in, is what that's called. Just roll up, roll down, roll out, and roll in. And these are ways to take money off of the table or buy more duration, or get money back that you put in if things went in your favor already and you still want your options to ride. It's called rolling options. Did you want to say something, Sachin?
No, sorry, it wasn't me.
Okay.
Yeah.
So that's kind of difficult to explain, and probably I will need to do it on a whiteboard sometime or with the computer here. But she asked about rolling, so I wanted to talk about it. So that was what that is. So we have like 19 more minutes in this session. So I'm happy to go over puts again or whatever else you would like to talk about, or a trade that happened today or anything.
Yeah, so I joined a little late, so I don't know all the swings trades you guys did. Do you have any trade that you can go over, even like your entry and exits and the performance of the trade overall? Um, Anything you can share would be great.
Yeah, I think what's important to note, like if we went back to EPAM, that example that I gave before, and it's loading. Let me just. It's a good thing I don't use TradingView to trade options, which they do allow. It takes forever to load stocks sometimes. Okay, there we go. Okay, cool. So on that EPAM stock we were looking at, oh, I think if I zoom up, it helped you last time. Let me do that. So you can see that pretty good?
Yes, yes, sir.
Cool, cool. So in our example, it was like 5 days ago or a week ago or whatever, we were right here. And I was giving prices and examples of like what it would be like to buy the options out of the money, at the money, and in the money. And we were saying, hey, what if in a week, it was right here? Well, actually today it's all way up here. It's like 1 day early and 10 points more. But this is one of my favorite core swing trading stocks. So, I wouldn't expect anything less. I mean, look at the vertical runs that it goes on, and then it has a little consolidation and then vertical run, right? And then consolidation. And if you could have got in there, vertical run, So that's something that now we can actually look at like how much money we would have made in that situation. So if you sold today, it would have been at 335, and with the out of the money, it would have been from 315 that you would have made money. So you would have had $20 per share times the terrible delta of whatever the out the money was. It probably was like 25 cents a share of profit. So 25 times probably 0.25, so $6.25 a share of profit. But had you bought the in the money, in stark contrast, you'd be talking about 310 essentially all the way up to 335, which is, wait, 25. So how come that's different? I did the wrong math on that last one. Oh, 20. Last one was 20. 20 times 0.25, which is $5 per share. Whereas this one, in the money, as you know, would be 0.75 delta on $25 of range. So you'd be talking about $18.75 per share of profit. But it's even better than that, because when the price goes way up here, the delta gets to close to 90 or 100. So it's closer to about 20 instead of 25, it's closer to like probably $21 per share of profit, something like that. And so that's quite a difference between $5 per share on the out of the money. But the, you know, truthfully, the out of the money would have cost 1/10 the price of the in the money. But we've gone over this before. You're also putting most of your money, 90% of your money at risk when you buy an out of the money option. So that was just a good example of it happening, and probably Tesla too. So you could see if you had bought Tesla down here at 330, my alert target was 380. Anything below 380, buy. I mean, if you had unlimited money, not unlimited, but if you had enough money to buy more than one contract, you know, you would buy one contract on this day below 380, and then it falls down to 330, and you'd buy another one, and the next day it's still below 380. Get yourself another one. Every day that it's below 380 is another opportunity, because soon enough it's gonna go back to its price target, and you would have a bunch of options. I was up $5,000 on that one option that I paid $9,000 for. 5,000 today, and it's only halfway to the profit target.
Right.
So, you know, if you had 5 of those, you'd be up 25 grand a day. But to buy 100 shares of Tesla would cost you $34,000 down there, or 38,000, or 41,000. So that's one of the beauties of options. I just, you know, now we can see on a day like today some of the proof, you know, of the beauty of that leverage. Because it can work inversely too. You can make the same amount of money as you would have had you paid for the stock, but for less risk exposure. It doesn't always have to be leverage in the other direction. Like, hey, if I'm going to buy $40,000 worth of Tesla, I might as well get 130 contracts, or whatever, you know, the multiple is. No, you can invest the $40,000 in Tesla, but for $4,000, you know, or $9,000, whatever it is. So you're saving a lot of risk exposure. Any other thoughts come to your head, Sachin, to talk about? So trades, you said.
No, yeah. So that's a good example. The earlier the EPAM one, EPAM.
Yeah, I mean, especially because it's such an obvious channeler.
Right, right.
I mean, just go in, you know, during, you know, its typical pullback, you know, do the statistics on it. That's what I do. You know, I measure. If you look at like Amazon, I measure all those points. I have all those measurements and statistics worked out. I know it's going to be between, you know, 4 days and 11 trading days that I'm going to get between 7% and 18% move. And so, you know, I'm on that option right now. I bought that. This is representing my option, you know, the way we talked about it the other day with that rectangular box. And so right now, like, I'm down 35%, but I'm okay with that. You know, if I had more money, I would buy more here.
Right, right.
You know, I have no problem with that. I mean, Amazon is like so great. By the time this option is way over here, we've got an earnings report coming out, and, you know, hopefully the market picks up. If this thing starts charging way down here like a bull, like a bear, you know, I'm going to think twice and I'm going to probably liquidate. But if it's just ranging around where it normally consolidates, I'm okay with that. And then it will just start to leap forward on one of those days, as it has done 15 times this year already. 100% every time, 100% likelihood every time. If it doesn't do it this one time, I'm also okay with that problem, because that's still only 1 out of 16 times that it did not. And I'm still good for Amazon, it being a 95% winner.
Yeah, so the in the money and out of the money, in that example earlier, EPAM. So in the money, the premium is usually higher, right, compared to just slightly out of the money. So what would you say, like, if you have a good conviction on the stock direction, and if you go slightly below or at the money, okay, let's say at the money call, you pay less premium. Would you not say that that would be, yeah, granted, like delta would not be high, but yeah, but I'm not paying upfront so much premium on the calls. So, what would you recommend? Would you still say always go for in the money rather than at the money calls, or would you say, yeah, if
Well,
there's
I
a
mean, it just depends how much. It kind of just depends how much you want to put the bet at risk. That's really it. It's kind of like all those factors, all these different in the money, at the money, and out of the money rectangles here. They all kind of backward factor into how much you just put your money at risk. And if I were to have chosen an earlier expiration, even more risk, right? You know, like you're basically saying, hey, this thing absolutely has to skyrocket in my direction or I'm going to get killed. Because remember, if you had the out of the money on this EPAM and it's where it is today, then you have to beat, for like tomorrow and every day thereafter, you have to beat this line in order for you to make any more money than where it's at today had you sold.
I see. Yeah, yeah, yeah. Okay.
So with options, especially at the money and out of the money, whenever you have a strong move, you should sell because you can't just say, oh, well, let it consolidate a little bit and go a little higher. You'll lose gains.
Yeah, time decay. Yeah, I'm gonna kill
Yeah, it
you.
might not be, yeah, it's from the time decay. It is from that, but you knew that going in when you bought it. If you could like figure out the angles, these angles here, you could see which ones are plausible and which ones are implausible and which ones are stupid and which ones are smart. You know what I mean? And the one that's green and almost flat, it's like overly smart. It's like an accountant would get that one. It's very conservative, you know. And yet, in my opinion, it's best to get that one because it's stocks can still go down, man. You can still lose even conservatively bet money. So, but you'll find me getting at the monies for a day trade, or if I know that I'm going to be in something for just an overnight, I'll get at the monies. If I know that something has a lot of potential, and when I go look at the options chain, the out of the monies are like $5 a contract, I'll just buy 100 of those because I only need them to go to $10 a contract to double my money. I don't need them to go to 84 cents or some shit. Like, that's why out of the money options can have potential, but you have to realize that if you're wrong, you probably won't even be able to sell your options back at market for zero. Like, no one will want to buy an out of the money option when the price has gone the other way. It's so far out of the money that there's just no demand for it anymore. So when you buy an out of the money option, that's why they call them lottery tickets. It's like you've spent the money. All you have now is scratch off value.
Right.
You
Yeah.
know? So out of the money is a full bet, is a full risk bet. At the money is a half risk bet, and in the money is a low risk bet.
Got
And
it.
then when you add duration, you're helping your situation a bit.
Okay. Can we do one small quick exercise? I have one contract I'm eyeballing, and I think I want to buy this for swing. See,
Which
I
one?
just
Eyeball?
yeah. So I just pinged you the contract inside Discord.
Bank of America?
Yeah, Bank of America. So I'm eyeballing this contract. I want to buy this in the money call to swing, and I'm very positive on this.
Right.
So
Because it's doing this, you know, so you can kind of expect that out of it, right?
right.
So now, right now is a decent time to buy, but you should be aware that Bank of America moves really freaking slow. So you probably want to buy like a January contract if you're
Yeah.
expecting to swing trade that and sell it at kind of this top line somewhere.
Yeah. So you see the earning date even.
What?
Do you see the earnings date? See, the earning is in
Yeah, yeah, yeah.
mid-October.
Yes.
So that's my play.
Yeah, yeah, and it's put, there's two things that will go in your favor in that. One, stocks actually, it's a proven thing. You can go look it up. Like almost 80% of the time, they start going up into earnings for the 3 weeks, you know?
Right,
The
right.
last week, it can get kind of iffy, but yeah. And then also, options volatility goes up as earnings approach. So you have two things working in your favor there. So that's kind of a good opportunity.
Yeah, I took a position today in this.
Oh, good. And low risk because Bank of America doesn't really move a lot. I mean, you won't get
Yeah.
killed on that.
So market is a little nervous. So what I did, I saw the IV is 39%, right?
What's it at right now?
Uh, 39%.
That's it? Oh, that's great.
Yeah,
It'll go to 120% by the time. Uh,
exactly. So I saw this option and I'm like, there's no way I'm gonna let this go. And I got in the money call. So I took two contracts just to probably I'll collect two more tomorrow and like try to build a position up to 10 in this contract.
yeah, it's good. I like the play. Sounds good to me. I mean, it sounds also not too deadly because,
Exactly.
yeah,
Exactly.
I think, it's a bank. I think, the earnings are going to
Yeah.
be not that big of a surprise.
Right. 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 They're very steady, and then the channel is there. You saw the channel, right?
Channel's there. It's probably
Yeah.
going to, before earnings, it might just follow this line. At
Exactly.
worst, it might just follow this line. At best, it might go to the middle.
Yeah.
Uh, and then when earnings come out, I don't know. Are you going to sell before then?
Yeah. If I see like it hits my target, I'll be out. Yeah. I don't want to hold it after
Because
earnings.
here's another thing you could do. Let's say Bank of America goes all the way up to the top here before earnings,
Yeah.
and it's 4 days before earnings.
I'm out.
But wait, but
Oh,
wait,
okay. Okay.
don't
Okay.
sell. Don't sell.
Okay. Okay.
When it's at a really overextended moment, check the puts and buy the delta equal put number of puts that
Oh,
would
I see.
that would balance out whatever your current delta is on that. You would get the puts like way down here, like way out of the money.
Yeah. 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 Yeah.
They'll be really
That's
cheap.
smart.
They'll be really cheap, but you delta balance it like that. It might cost you 5 or 10% of your position. And then when earnings come out, you'll have a strangle is what it's called. And
Uh-huh.
if they're good, your puts will be worthless. But if you sell them instantaneously in the morning, you'll still get $100 back or something like that.
Yeah.
But if it's bad, those puts and then the price
Hey,
goes down here, those puts will go way up in value. The volatility will drop a little bit, but mostly they'll go up in value, especially if they go in the money. And then you'll have winnings on both sides
yeah.
as a potential.
I like that. That's a very nice strategy.
I
Yeah.
do that. I do that a lot. The out of the money, but that only can happen when the price has rallied to a really nice overextended moment that you're like, I'm gonna sell. I mean, and then you're like, but what if the price goes up or down? I could still be up even if it goes down. No, the better play is now you buy out of the money options. Really, here's how I calculate it too. Check this out. Let's go back to like Apple is a great idea. You can actually see this. You can say, oh, they announced the split, and it was like right around here. They announced the split. Now from here to here, everybody bought in on that event. So the puts to buy should be the ones here. In other words, if people don't like the result of the event, the catalyst,
Right.
uh, all these people are the ones who were hoping that it was good. Everyone, minus the normal investment curve. So that angle there, you see that new angle, see that new channel formed,
Yep.
and this new channel here formed. This is the normal angle. Everything that's above and beyond normal represents where it's going to go back if people are dissatisfied with the results of the catalyst. So you would get like puts down here. So you can
Hmm.
actually kind of trajectory it out and project and figure out which out of the money puts you would go in the money, because you can figure out who's going to be out, because you already can see who got in on the catalyst. If the
Yep.
catalyst is bad, the people who are going to get out are the people who got in.
Makes sense. Yep.
But the people who are investing are going to stay in. That's a normal rate of occurrence. But above and beyond that are the people who would be out if things did not go the way the catalyst should have gone. So that's how you can figure which strike you should get for your out of the money puts if that were to happen.
No, that's a great tip. Thank you.
A very advanced little thing I
Yeah.
figured out.
Oh, it's very nice. Yeah, but the moment you said it, I'm like, oh my God, that's a no-brainer. And I get to collect some premium on puts, and that brings my cost down too.
Oh, you're going to sell puts and
Yes.
calls?
No,
Okay.
I'm saying like, oh yeah, no. Then I'm doing a naked position. That's not good.
Yeah, no, that would be good. But I was talking about just vanilla
Just buy
options.
puts. Yeah. Oh, okay. Got.
Call when it
Oh,
goes
okay.
up, you would make money, but you don't sell. Instead, you buy out of the money puts, and then you play the event.
Yeah. Okay. Yeah, it makes sense.
But you could, right before the event, the day before, when volatility is at its maximum, you could choose at that moment to do a verticals on both of those. This is a way more advanced, but you can sell out of the money on both sides to just basically lock in your gains, and it wouldn't